Good afternoon. It's Jeffrey Christian of CPM Group. It's about 3:10 in the afternoon on Tuesday, the 22nd of April here in New York. Gold broke above $3,500 today. Got up to about $3,509. It is currently trading around $3,402, having come off from that high. Silver did break above $33 earlier today and overnight, and it's trading around $32.88. I want to talk today about this time is different, but then again, maybe not. There are some incredible differences between the current bull market in gold and silver and the economic and political environment that's fueling the sharp increase. Gold prices were about $3,000 on 9th of August, and now it's touched 3,500. It's very important to remember that anything that goes up $500 in 10, 12 days can come down $500 in 10 to 12 days. We're not convinced that that is the case. I'll talk more about our view of the markets and where gold, silver, platinum, palladium are going toward the end of this discussion. I want to talk about some other things first. Before I start, I want to point out that I did make an error in what I was saying last Friday. I said that we thought the range of gold prices, I had said $1,200 to $3,500. I had meant to say $2,600 to $3,500 over the next 3 months. Our expectation is that the price of gold can come off. It was $2,662 on the first trading day of this year. So maybe up $500 since April 9th, but it's up $900 or $850 since the beginning of the year. I also want to clarify something. I put a link up to a Milton Friedman commentary video in last Friday's video of Friedman talking about the negative consequences of tariffs. And I want to clarify, it's not that I'm a believer in monetarism, but Milton Friedman is a real economist. He speaks honestly. He studies economics. He's contributed major important analyses and deepened the understanding related to monetary policy and how monetary policy and monetary trends interact with economics. He's somebody you could have had a substantive conversation with, devoid of the hyperbolic nonsense that you hear from prognosticators talking about $10,000 gold and $100 silver and stuff like that. I'll talk about some other things too. I hope that I can remember how to touch on everything as we go through. I want to point out another link. This is Patrick Boyle. He's an adjunct professor or such at King's College in England, and he is a co-founder of a hedge fund where he is the quantitative director for quantitative analysis there. He posted about a 37-minute presentation, or somebody posted, of him talking about what's going on in the global economy. It was titled, "Is China Dumping the Dollar? And is Ray Dalio right about reserve currencies?" He posted it on the 20th of April, Easter Sunday. It's worth watching. It's very dry and very straightforward. He is an excellent analyst, a very good presentation talking about the state of the financial markets as they adjust and respond to the uncertainties being created by the Trump administration. Like I said, it's about 37 minutes long, but it's really worth listening to, and it's very insightful. Now, I'm going to talk about this time is different and where we are in the markets. And the biggest difference that we're seeing right now between, say, now, the current market uptrend, and past spikes, 1978 into 1980, 2002 into 2011, and others, is that investors are not turning to gold and the dollar. They're turning to gold. And that's not all that unusual. I'll show you some charts and tables. I've said it very often in the past. When things get really ugly economically and politically and socially, people will turn to gold, the dollar, US Treasuries, and to some extent silver. That's been the case throughout history, or at least since the dollar and Treasury bills were around. Treasury bills are interesting because the U.S. Treasury has a very high credit rating. It is seen as, it used to be seen, and treasuries were called the riskless investments. There are risks there, but the risks in U.S. Treasuries are lower than the risks that you have in other sovereign debt, corporate debt, municipal debt, state bonds, and other forms of investments. So a lot of times you'll see when things get as ugly as they've been over the last 2 weeks and expectations plummet, all of a sudden you have consumer confidence falling, 50%. You have business investment falling sharply, business confidence falling sharply. Oftentimes you'll see people buying gold, pushing the price higher, and buying the dollar and buying treasuries because they're less risky. This time around, we're not seeing a surge into the dollar and we're not seeing a surge into treasuries. That probably reflects distaste for the U.S. government. The U.S. government and its bad policies, not just tariffs, but all sorts of policies, is really the culprit here in heightening investment risks, economic risks, pushing the world and the United States toward a recession, if not a recession, zero growth. Some people are talking about depressions, pushing inflation higher, creating a sharp reduction or threatening to create a sharp reduction in international trade, and international trade is already suffering, and realigning political aspects. One of the scenarios we haven't talked about in the past, but we've thought about, is the idea of a radical, dictatorially oriented U.S. government realigning alliances away from Europe, away from Japan, away from Taiwan, away from Australia, toward China and Russia. We haven't talked about it because it's pretty radical. This morning I got the current edition of Foreign Affairs. That's on the cover. So maybe it wasn't all that outrageous to think that that's a real risk. It's a real risk. Now, what we're seeing over the last several weeks is that the dollar has fallen and treasury bonds have fallen and gold prices have risen sharply. Yeah, $500 in the last 2 weeks. This is the JP Morgan trade weighted gold dollar index, that dollar index that a lot of people look at, right? On the 18th of April, last Friday, it was 109.8. That was off 1.8% from the end of the average month to date through the 18th of April was 109.8. The March average was 111.9, so that was off 1.8%. But if you look at the 18th of April dollar, it was off 4.3% from the beginning of April, the end of March, and it was off 6% from the end of 2024, 3.5 months ago. So dollar's fallen 6.5%. to the lowest level that you've seen since September of last year. And the March average was the highest dollar exchange rate since 2002. It's a long time ago. And it was up sharply from below 80 as recently as 2011. So yes, the dollar has fallen, but it is still very high, and one has to pay attention to it. We use the JP Morgan in some of our research. We also use the Fed trade-weighted dollar, and there you see that it's off 1% since on a month-to-date average compared to the March average. It's off 2.8% from the end of March, and it's off 4.8%. And you can see, yes, it's all the way back to where it was last October. So the dollar has fallen from a high level, something to pay attention to. This is a chart and table that we produce and update every month in our precious metals advisory. And it's not the correlation from 1868 to 2024. It's a correlation from 1968 to 2024. I'll point out my error in the video so that you don't have to send comments like 1868, really? And you can see that the correlation is very low. It's negative 34%. That means that 66% of the time, the dollar and gold are not moving in opposite directions. Sometimes they're moving together, both rising or both falling. And sometimes one's rising and or falling and the other one's doing nothing. And you can see various periods of time when they've both been rising. 1976, 1977, when inflation was a problem, when we were coming out of the 1973-75 recession. 1982, 1983, when we were coming out of the double dip recession between 1980 and 1982, the middle of 1982. And then again, 2005 for a couple quarters, and 2009 for a couple quarters. So it's not unusual that the dollar and gold both rise together, and it's not unusual that they don't rise. That it's more often the case that they are not moving in opposite directions. It is unusual that in this kind of economic and political environment, you're not seeing investors move into the dollar and treasuries as well as gold. And that's how this time is different. And I think that suggests real concerns on the part of investors universally about the outlook for where things could go. This is just another chart. This one's from our gold yearbook. These are treasury bill rates, the nominal rates in brown and the real interest rate adjusted for CPI is in magenta, I guess that is. Gold prices are in blue. And you can see, back in the 70s, we had an extended period of time of negative real T-bill rates. And it really went from like 1973, 74 into 1980. But since that time, we have had an extended period of time for most of the last 25 years where we've had negative real interest rates. The nominal T-bill rate adjusted for inflation has given you a loss on an inflation-adjusted basis for most of the last 25 years. We have moved positive in the last few years since coming out of the COVID lockdown. I want to stop here and talk about something. Psychologists talk about insecure people, and they say that one of the things that you'll see about insecure people is they resort to name calling, and they don't talk about, I like Milton Friedman, but I'm not big game on monetarism as a theory, and here's why, and I'll talk about monetarism. An insecure person might call Milton Friedman names, and those names that they choose to call people often are projections of their own insecurities. And I bring this up because in the last 3 days, Donald Trump, the president of the United States, has called the senator from Maryland that went down to El Salvador to check on his constituent that has been improperly sent to El Salvador prison. He called him a fake. He called Federal Reserve Board Chairman Powell loser. And he said that any businessman who is complaining about his tariff policies is a bad business person. Now, obviously, the senator is not a fake. Jerome Powell is far smarter and far better as a human and as an economist than Mr. Trump. And those business people haven't driven most of their companies into bankruptcy and threatened the entire global economy with a depression, the way Mr. Trump has. Just a psychological point of view. I did study some psychology in school, but I'm not a psychologist. A more interesting thing is, how do you deal with a bully? And I have gone on record saying, got a lot of history dealing with bullies since I was a kid. And I know that what you do is you turn on them and you stare them down. Harvard is now challenging the Trump administration with some of the Trump administration's inappropriate and illegal policies. New York State is challenging the Trump administration with some of its inappropriate policies, including clawing back $80 billion from some other program earlier, threatening all kinds of sanctions against New York State, and trying to end congestion pricing in lower Manhattan. Harvard has $53 billion in its endowment. Our estimate is that perhaps 5 to 10 billion of that is in US Treasuries. New York State has a thing called the Common Retirement Fund, and it has about $273 billion. It's a pension fund for various government, state and local employees in there. And our estimate is that perhaps 30 billion of that is in US Treasuries. The US Treasury market is under the gun. It's got real problems. Our budget deficit is exploding. Our budget deficit this year and next year probably will be something like 30 to 40% higher, greater, larger than the $1.7 trillion that had been anticipated and the $1.7 trillion budget deficit that we had last year. We are gathering debt at a record level on the federal level. That debt, those deficits have to be financed by selling US Treasuries, more and more of them. And the private sector has been saying, we don't want the US Treasuries. That's why the interest rate is higher and the Treasury prices are falling. It would behoove Harvard to say, we need to make up $2.2 billion in research grants. We can afford to take that out of our $53 billion endowment. We don't want to do that. We don't want to do it year in, year out, but we can. And if we have to liquidate $2.2 billion or more of our endowment, let's sell the US Treasuries. Similarly, New York State and other state governments and other groups that have large treasuries can say, if we need to liquidate some of our assets to cover monies that are not coming from the federal government because of Trump administration policies, let's liquidate our treasuries. That's how you deal with a thug. These guys are looting the country. $580 billion a year of tax cuts for wealthy corporations and billionaires. It's only fair to fight fire with fire, but that's beside the point. I also want to review inflation because there's this view that inflation is dead. We have seen 1 month of a contraction on a month-to-month basis in the consumer price index. It's all oil. And on a 12-month rate of change, you have seen a decline in both the headline inflation, all items, that's the blue line, and the all items less the more volatile food and energy. All items less food and energy have fallen to 2.8%, and the headline has fallen to 2.4%, which is where it was last September. So good inflation data, except when you disaggregate it. I'll get to that in a second. I'm going to show you producer prices. I ran through these earlier in April when they came out. This is all data that is through March that came out in the middle of April. And on a producer price basis, we actually have on a 1 month rate of change, month to month change, you have deflation for 1 month, not going to continue. And on a 12-month average, where we are from 12 compared to 12 months ago, we have seen a down dip, mostly in the demand for goods. Services have seen some decline in the prices that they're being charged, and the headline, the black line, has also changed. But we are far from where the Fed and other economists would like us to be in terms of inflation. We're not there yet. And as I showed you last month, the decline last month was centered on petroleum products, gasoline and fuel oil. Gasoline fell, I think it was 9.8%, and fuel oil fell 8.5% or 8.8%. Most other goods and services, the prices rose, including eggs. Eggs were up 6.5% in March after a 10% rise in February. So eggs are important. They had taken on far too much attention in the meme world, but the reality is that food prices actually rose 3% in March compared to March of 2024. So food prices are still rising, and energy prices are still rising too, for if you look at it all on a year-over-year basis. And all items less food and energy rose 2.8%. And across the board, with the exception of a couple things, you saw rising prices. So inflation's not dead. Let's talk about the markets. As I said, gold touched 3,500 this morning. It's 3,400 today. There are a couple questions to deal with. Is this the time to take profits? And the more important question is, have the factors that have driven gold prices higher actually changed? That's the important question. And the answer is no. If gold prices have risen since they were $2,660 at the start of the year, $3,500 today, $840 increase in the gold price. Gold prices were $3,000 2 weeks ago. They've risen $500 since then. Anything that rises $500 in less than 2 weeks can fall $500 in less than 2 weeks too. The fundamentals of the gold market have changed somewhat. As with silver, you have a well-supplied New York market, and you actually have gold being shipped back to London and to other major markets because the gold market in New York has been a little oversupplied. You have seen investors and central banks pull back from buying so much gold. Central banks bought 40% less gold last year than they did in 2023, and they're buying less this year. Through the first 2 months of this year, they were up, but that reflected the fact that in February, the Russian central bank bought about 3.2 million ounces of gold, replenishing its gold reserves after selling gold for several months in January and December and other months in 2024. It's using its gold reserves to fund the government as well as to fund its war effort against Ukraine. But in March, the Russian central bank sold 3.5 million ounces or so, more than 3 million ounces, more than offsetting the February purchase because it needed cash. So it'll be interesting to see what the final March figures are, April figures, but you're seeing price sensitivity here too. Other central banks that haven't been waging war on their neighbors, but have been buying gold slowly but steadily, have pulled back because of the gold prices higher. They're spending less money on gold in 2024 and 2025 than they did in 2023, But because the gold prices are higher, $2,000 in 2023, $2,600 toward the end of 2024, they're getting fewer ounces of gold investing per dollar. So the first question, the important question is, no, the factors haven't changed. The fundamentals have changed, but the big drivers, economic, political, and social anxieties and uncertainties, heightened financial market risks, heightened political risks, heightened economic risks, those are all still in place, and if anything, have gotten worse. Now, they may subside over the next several months, or financial markets may normalize the new riskier environment that has happened numerous times around the world. But for now, they're in place. So that would suggest you want to stay long gold and silver, financial assets, safe havens, portfolio diversifiers. But you also have to pay attention to the fact that the price has risen so fast, it could come up. So we've been spending, and one of the reasons why I'm doing this video at 3 o'clock instead of my usual 10 or 11 o'clock in the morning, is because we've been spending much of this day helping our clients buy puts to hedge their long exposure. Stay long the physical, but buy insurance against a short-term decline in the price of gold over the next week and over the next several months. So that's really where we are. We're watching investors pull back from physical purchases. We're watching central banks pull back from physical purchases. We see a pretty well-supplied gold market globally. And in that kind of environment, any reduction in the fear and anxiety and uncertainties that investors are facing can trigger a significant decline. Think of it this way. The gold price dropped $100 today to a record $3,400. Can it fall to $3,150? Yes. Can it fall to $3,000? Yes. Can it fall to $2,060? $2,650? Don't want to make that mistake 2 weeks in a row. Yes, it can. Because it's all, the price of gold is predicated on the value that people are willing to buy and sell it at in the market. I mean, it's no full faith and credit of any government behind gold. Thank you very much. We don't want that. Gold's price is predicated on what people are willing to pay for it. Right now, people are willing to pay $3,400 for it because they're extremely worried about the state of the world, the state of their country, the state of their local community, whether they're going to be beaten up walking down the street because of the way they look. It's a tough time. You want to stay long gold, but you also may want to hedge your position. Silver continues to lag gold. It will continue to lag gold. There's a tremendous amount of silver that's built up in the New York market. It's not being shipped back to London yet because the arbitrage, the spread between London and New York prices is not sufficiently great enough to pay for shipping it back. And there are also some logistical issues. Silver goes by ship, gold goes by plane. Silver prices $32.80 right now, $33 earlier today overnight in Asia. That's a high price for silver. It's close to the record annual average price for silver back in 2011, 2012. We do think that the silver price will rise further, but the reality is that it will probably not play catch up with gold because gold is universally seen as that safe haven portfolio diversifier, hedge against risks, currencies, stock market, bond market, political risks, social risks. Silver is seen like that, but if you look at where it's primarily purchased in North America, the United States and Canada, and secondarily in the Indian subcontinent. It is far less universally seen as the place to go when things get tough, as is gold. We do think it benefits from that. It's also being deprecated right now by the fact that a lot of people are seeing lower economic activity. They're seeing cutbacks in manufacturing of various products that contain silver. You're seeing lower jewelry demand and lower demand for silver statuary and silverware objects because people are hoarding their money because they're concerned about what comes next, both personally and in terms of their society. So silver's got a couple headwinds compared to gold. It probably will continue to rise. Our expectation is that it will continue to rise, but it's going to be a tougher slog for silver than for gold. And platinum and palladium primarily are used in auto catalysts, and the auto industry is facing a lot of problems. The price has been trading, platinum's been trading between 900 and 1,050 for the last several years. Our expectation is it's probably going to continue to trade that way. It came down and tested that low in early April. It has now risen back up into the middle of that range, and we expect that range to continue to hold because the palladium and platinum demand in the auto industry is suffering from a variety of factors. Similar situation in palladium. That's what I have for now. You can go to our website. You can buy our gold yearbook that came out in March. You can pre-order our silver yearbook that comes out in May, or our Platinum Group Metals yearbook that comes out in July. You can see all kinds of free reads and other things. You can sign up for our retail investor program, which is a lower price point way to get our research and consulting services. It includes gold, silver, platinum, palladium trade recommendations, which are these ultra short-term trade recommendations. And once you're part of our clientele, even if it's through the retail investor program, you then get to plug into our quarterly open forums, and you have a direct line of communications to discuss things with us. You can always send us an email at info@cpmgroup.com. Ask us questions, discuss ways that we can help you with your precious metals and commodities investments. That's all I have. Take care of yourself. Take care of people around you. I guess it's Earth Day. I remember the first one way back when. I remember a lot of them in between. Try to do something good for the world. Mother Nature, as well as the political and economics and social environment that resides on the surface of the earth. We'll talk to you later in the week.